So if assuming you manage to stave off all the zombie hordes that are after you to steal your food, eventually you run out of whatever diesel you had in the tank. You can't necessarily machine. Very few people are capable of machining all the parts they need for their tractors and combines and whatever. And then we're sort of plunged back into best case scenario, 18th century agrarian, before any technology that as we think of it as such, occurs.
Yeah,
And
but
this
with
is
much less skill because none of us know how to do that anymore.
Nobody knows how to do that anymore, which makes it a lot worse than 476 AD, where most people still had ties to the land.
Hey guys, Raf here from the Endgame Investor, and today I have Keith Weiner. He was with me once when I started doing interviews. Now he's with me again, and it's really nice to have Keith on because in the metals community, there are a lot of people that recognize and know what the Austrian School of Economics is, but very few of us are actually Austrian economists, and Keith is one of them. So we can get a little bit more into the Austrian School of Economics side of the metals equation and what is going on in the markets from a more scholarly perspective, I would hope. And Keith knows a lot more than me. I'm not an academic. I have some aversion to academia, but Keith got a PhD from Antel Fekete. Maybe not in a traditional setting, but yes, that is my understanding, right?
Yeah, I was going to say I don't consider myself to be an academic either. Consider myself to be an entrepreneur, but the work was real anyway.
Yeah, the work was real, and you do know more about it than most people in our community. So I wanted to get into that. Okay, so I have 5 questions lined up here, and talking about it from like a Misesian perspective on what is going on in the monetary sphere. So I am the endgame investor, and that my thesis is that the endgame, meaning Mises' crack up boom, or hyperinflation, or whatever you want to call it, death of the dollar. These are all synonyms for the same thing. It's eventually going to happen. My thesis is that we have one more round of monetary inflation, of money printing, that will take place after the next financial crisis, and then we will probably have a crack up boom. That's what my thinking is, because of the angle of ascent of the money supply, and it really went vertical after the lockdown printing, and now it's going down, and when that happens, you generally have a financial crisis. Murray Rothbard points out in America's Great Depression. So do you find any holes in my thesis? Do you think that the crack up boom is imminent, or do you think it's years away, or what do you think is going on?
I was going to say if it's not sacrilege to bring Adam Smith to a Austrian discussion.
Depends what part of Adam Smith you're going to tell me, but he wasn't completely bad, but Murray did not like
Yeah,
him.
no, there are problems there, to be sure, but his quote about there's a great deal of ruin in a nation, which he offers as an explanation for why, when they impose bad policies, you don't get a collapse as quickly as you might expect. So I think that just in my view, they're precipitating. I mean, the cause of the bust is the false boom that preceded it. So I wouldn't say that the Fed rate hikes are the cause of the coming bust and crisis, but rather precipitate it. It's already in the solution. You had one drop of ammonium sulfate or whatever it is, and then suddenly all the stuff precipitates and drops to the bottom. And then following that, they're going to do a 2008 style stimulus bailout, whatever you want to call it. They always give it new names. The old names get a bad reputation, right? So then they won't call it quantitative easing next time. There'll be some newfangled terminology that they'll coin for it. But something akin to what they did in 2008, only exponentially bigger. So 2008, I remember thinking every number that you could look at economically was either straight vertical shot to the moon or a complete fall off the cliff into the abyss. And then when you look at what they did in 2020, it makes 2008 barely look like a speed bump. It's hardly even visible, right?
Well, but actually, if you look at 2008, if you look at the actual money supply, it didn't move that much. The printing was like way deeper down into the system in the reserves, somewhere like in the basement where we didn't even know existed.
Yeah, I mean, right, if you look at M0, I think it was a triple. If you look at M3, not obviously anywhere near that. 2020 was different a bit in some ways. Anyways, I think what they're going to do after this one will be even bigger, like, gobsmackingly, stupefyingly bigger. But I think that, in terms of the US dollar and in terms of America, I'll put an asterisk on that, get back to other countries in the world. I think collapse is a number of years off, yet, and maybe even longer, maybe a decade. I mean, and maybe more. I don't think it's imminent.
So you're saying you're not sure what happens in America, but you think other countries have a little bit more time?
No, I'm saying America will have the most time. It's definitely not imminent here.
Oh.
Other countries, things could happen, really bad things could happen sooner. Because whenever you have a collapse, it starts on the periphery and works its way to the center. The US dollar is the center. And so I think this will be one of those situations where a lot of Americans who don't really understand economics at all are just rah-rah for what they feel is patriotism or nationalism. And they'll end up being right for all the wrong reasons. Yeah, we're America, we're better. Well, that isn't what's going on with the dollar at this point. It's a very perverse monetary system. Most people don't realize the architect of this monetary system was a proven tool working for the Soviet Union, a proven trader. Harry Dexter White was the Treasury Department official who dictated terms at Bretton Woods. And it was dictating, right? I mean, the US in 1944 was the only superpower standing, and the US said to the rest of the world, this is how it's going to be, whether you like it or not. And the rest of the world said, thank you, sir, may we please have another? And that was Bretton Woods. Mm-hmm. Obviously, Germany was not there in 1944, but in the post-war, reality, Germany, had no choice but to join it. And so everybody assumed that this crazy system was to the advantage of America because it was to the disadvantage of the rest of the world. There's kind of a perverse zero-sum thinking. Well, if it's hurting someone else, it must be good, for you. When in fact, Harry Dexter White, no question in my mind, his intention was to undermine and cause the collapse and overthrow of America in favor of the Soviet masters. And so he sowed the seeds for an enormously destructive system, but it gets America last. And then I don't think that was necessarily his intention. I don't think you grasp that. But such the system is, the rest of the world uses the US dollar as if it were money. And between 1944 and 1971, the US dollar was redeemable for gold to the governments of the rest of the world. After 1971, Nixon, of course, put the kibosh on that. But we're still stuck in the vestiges, not even the vestiges, the consequences of that monumental architectural decision in 1944. And so the US is the center of the credit universe, and it's a credit system. So I think depending on policies and geopolitical realities, other countries may experience real crisis sooner. Eventually crisis will come to America, but it will come to America last.
Okay, so you do believe there is an end game for the dollar. Eventually it must collapse because that's the end of all fiat monetary systems. But you're giving it more time than I give it, basically.
Yeah, and so my thesis, I don't necessarily use the term crack a boom. My thesis is a gold sort of lens, and it's called permanent gold backwardation. That the dollar has value to the extent that gold bids on it. And when gold withdraws its bid from the dollar, it's game over. And that the process of withdrawing the gold bid will cause a hyperinflation of all the commodities as a function of arbitrage. It's not anybody desiring this outcome necessarily, but just an arbitrage will pull all the other commodities to have infinite prices. until somebody says, okay, stick a fork in it, it's done.
Right. So that was Professor Fiquete's way of looking at the crack up boom. I see it's a different way it's a different perspective on it, but I think they're describing the same thing.
In my view, and I try to be careful in how I present what I think Fekete thought versus my own thoughts. My own thinking is a little bit more about, well, okay, so his Wikipedia entry talks about that he's the promoter of the quality theory of money, not the quantity theory, and I think he'd be 100% on board with that. But looking at the quality, it's really about the debtor and can the debtor service or pay the debt. And so to me, it's not about, is the quantity of dollars going up necessarily. I mean, obviously it is. That's not something I deny. But to me, that's not the most important thing. It's the quality of the debt's going down. More and more of this debt is being incurred for, to finance things that just absolutely will never produce an income to service it, let alone, pay it off.
Yeah, I think Daniel Oliver has a similar view, the liquidity theory of money or something like that. But before we get too deep into the new Austrian school and the technical aspects of it, I wanted to move on with my questions because some of them I'm really curious about. So I heard you say in your previous interview that you think that interest rates are not reflective of time preference, that time preference is for a lower interest rate than it is now. So you think rates are going lower. Do I have that correct? Is that what you believe?
So time preference is half of the interest rate equation. The other half is productivity of capital or return on capital.
Okay. So my question is, how is it possible that and I'm gonna interrupt this with my own analogy of what I think might be happening and tell me if you think it's a good analogy or if I'm way off. How is it possible that nominal interest rates are what, 5%? What's the Fed funds rate? I don't know, whatever. Let's just say it's 5%, but real interest rates are still negative, right? You still have minus consumer price inflation or some heuristic or estimation of it. Real interest rates are still negative. Now, how is it possible for real interest rate to ever be negative? Because nobody is immortal. So what I think might be happening is that if someone were to tell me that I had a whole bunch of money in a bank account somewhere, and that it's unlimited, or it's $1 billion or whatever, purchasing power is so high that I would never have to worry about life expenses again. I could just buy anything I want. Then my time preference rates would go to the roof, right? I wouldn't care because I would just spend whatever because I have infinite resources. So that's what perpetual money printing does. It just makes people think that they're richer than they are, so that and they don't demand any interest on their debt, on their savings, right? But then the bust comes when they realize they don't actually have that money, and what they were doing was spending their future, and now they're destitute. Is that so back to the question, how can real interest rates ever be negative given that we're all going to die? What the hell is happening?
So we take the first part first, which is, they print all this money, but of course it's really a process of borrowing. And so I like to frame the question this way. It's not a question of, okay, suppose you have $100 million in the bank. Suppose you have $99.8 million of debt that you owe and $100 million in the bank. Or better yet, suppose you have $200 million in debt and $100 million in the bank. How do you manage your bank balance if you owe $200 million versus if you're free and clear? So the average, retail investor is trying to analyze this kind of assumes that the system is comprised of people who are similarly situated to themselves, which is you have one side of the balance sheet, you have assets and not really liabilities. Or if you owe some money on your mortgage, you're not really thinking about that in the context of your investment portfolio. But of course, all the big players in the financial system have a liability on the other side, and all the corporations that produce all the goods and services.
But then again, if you fold it back onto itself, the dollars that are in your account, even if you have no debt at all, the dollars that you have, the assets you have themselves are debt. So you keep folding in on itself.
That's right. So the debt is going up just as fast or faster. It's going up faster than the amount of cash or liquidity in the system anyway, even during the boom. So people don't actually have $100 million in the bank. They have assets whose market price is $100 million. And then if everybody wants to sell all the assets, then obviously the asset prices collapse. The debt remains, of course, that being the nature. So you borrow 100 million to buy $100 million property, the property market collapses. You still owe the 100 million, but the property is not worth anywhere near 100 million anymore. And so the rising debt levels cause a rising liquidity preference, which is part of this. There was another part to your question that I also wanted to tell. Oh, it was the real interest rates thing. So I have a little rant, and if I may just jump on this just for a moment, because I think hopefully it helps shed some light on this. And that is that the actual rate that actual lenders actually lend actual dollars to actual borrowers, we call that nominal. And then separately, we calculate a consumer price index that even the proponents of this can't really agree as to what goods ought to go into the basket of goods for the consumer price index, nor the weights that those goods should be attached. But we produce the CPI, then which is a fictitious or a hypothetical number, we subtract that from the nominal interest rate to get the real interest rate. Right. So how can real interest rates be negative? There can be enormous non-monetary forces pushing consumer prices up that are not monetary, and therefore you don't see an effect in the interest rate, or if anything, it's a downward effect in the interest rate. So what we see, certainly post-COVID, it's been the long trend going back to 1981, is compressing profit margins. So it's ultimately profit margin in a business that determines what it can, at what rate it can afford to borrow. Suppose you run a chain of hamburger restaurants, you're considering opening the marginal restaurant, the marginal unit, and you calculate that you're going to get a return on capital of 4%. You cannot borrow at 5% or 8% or 10%. You have to borrow, it has to be somewhere under 4, sufficiently under 4 that you have a safety margin, and you'll still make a profit even if it turns out to be less profitable than you calculate it to be. And so there's this, this is the ceiling on the rate of interest, is you can't get any business borrowing if the interest rate is above marginal return on capital, or you don't get very much. So you get anemic demand for credit on an uptick in the interest rate, and only you get demand for credit only in any big way, only on a downtick in the interest rate. The floor into the interest rate is set by marginal time preference, which they monkey around with by incentivizing everybody like a siren to go into debt, and the more debt you have, the more that your demand for liquid cash is. So they monkey around with both sides, but both of them have been in a pathological falling trend basically since 1981, with gyrations along the way. We're in a gyration right now, but I don't see corporations saying the higher interest. So in the previous cycle, 1947 to 1981, the more the interest rate went up, the more corporations would sell more bonds to borrow more to chase it up even further. At the same time,
why did that happen back then, and why isn't it happening now?
So 1947, you had the interest rate pushed below consumers or individual savers / consumers' marginal time preference. So you have interest pushed below time preference, which it never should be in a free market. This is an impossibility. So consumers begin to trade what I call a bank balance for a pantry balance. I remember my parents, but they weren't really unique. Go shopping and buy like 100 cans of tuna fish or 50 boxes of Kleenex.
That's how people behave. That's how people behave when they're abandoning the currency. That's what happens.
And then the higher prices went. Sure, the interest rate ticked up, but not enough to overcome the even higher time preference that then occurred. So you get this ratcheting upwards of time preference and consumer prices. Corporations get into the act because if you can borrow money to buy your raw materials and put them on the slow boat, and then spend 6 months or so transforming the raw materials into your finished goods, it's a guaranteed way to make a profit from inflation. You're buying the stuff when the price level's at 100, let's say. By the time 6 months later you're selling at the price levels at 110 or 115, And so corporations are borrowing more to fill up warehouses with raw materials and partially completed work in progress. It was a period of inventory and raw material expansion. Post 1981 is lean, just in time, it's squeeze all the inventory out of the system. And that's still where we are today. So the corporations today are just not in the mode, nor do they have the balance sheets. There's so many things that are different between today and the 1970s. The best way that I can think of to try to help people see this is it's easy and tempting to see the economy as a stateless system or stateless function. So think of, sine of X or any simple mathematical formula. You give it an input and you get an output, which is deterministic. There's no memory inside the function. But of course, people and economic actors are stateful. They have memory, they have balance sheets. Just to name two differences, we're just not in the same economic world that we were in the 1970s.
Mm-hmm.
So you get this perversity. The thing that's most frustrating to me is to see the so-called modern monetary theory people. It's not modern. It's actually ancient. It's not really a theory. A theory is supposed to begin with an observation and go from there. And it isn't really about money. It's about this rubbish printing press paper that they advocate. But the most frustrating thing for me is to see them point to the lack of the hyperinflation that so many Austrians have predicted so many times, certainly since 2008. And they are smirking, they are gleeful, they are triumphant and saying, see, you're all wrong, we're right. Modern monetary theory is the way to go. Let the government print everything, feed the hungry, cool the earth, promote world peace, all the crap that they claim that this will lead to. And they're exploiting the fact that, a lot of people have made a wrong prediction. And there's nothing more that just grinds my gears to see them doing that. Mm-hmm. And because it's a glee they haven't earned. And nevertheless, they jump on it.
Okay. So my next question here is so Rothbard goes into in America's Great Depression. I referenced this before, that, and I show this chart a lot, that in the 1920s there was a boom, and that's really when the Fed really started to tinker with the money supply in a big way. It didn't do much from 1913 to 1920. It did some when there was a big depression and World War I printing, etc. But the Roaring '20s was really an expansion of the money supply in a way that the banking system had never seen before. And then it stopped in 1929. 1929, the expansion of the money supply was like 0.7% from January to June. And then 5 months later there was the big crash, and then Roosevelt messed everything up by intervening, and that extended it another 10 years, but that's a different story. Now we're seeing very similar action now in the money supply, right? If you look at the annualized growth year to year, it's actually negative, I think, for the first time since since that period, late 20s. And so far we haven't seen. We saw in 2008 in very similar numbers a negative absolute growth in the money in the M2 I'm talking about, but it doesn't matter which measure you use as long as you're consistent, right? So if we're in negative territory now, why aren't we seeing the incredible financial stress that we saw in 2008? Or my theory is that we saw such an enormous pump in 2020, 2021, that we have leftover extra money that was printed already that's now being used to fan the coal furnace, so to speak. But we're running out of that. Do you think that's a credible theory? Or do you just reject the notion that if the money supply is shrinking, we're definitely going to have a financial crisis anyway?
Well, I think we're definitely going to have one, and then the question is, how do you explain the lag? Yeah. Right. So even the proponents of this cockamamie system admit that there are long and variable, they say leads and lags. I'm not sure it's lead, but it's definitely lag, long and variable. If you look at just the startup community, and I know you have a sizable startup community in Israel, obviously Silicon Valley. And to me, it's more of an interest rate thing, but the money supply reflects as the interest rate falls, there's accelerated borrowing, and so that gets you that expansion. So either way you look at it, that period of expansion, capital becomes very cheap for even startups can raise obscene amounts of money. Then you slam everything in reverse. You say, okay, now we're going to shrink the money supply. We're going to hike interest rates. Well, it depends on when each individual company, when did they raise money and how much did they raise? It takes some finite amount of time for them to run out. So I guess in a certain sense, yes, what you said is true. They pump so much that a lot of the usual suspects that are burning capital still have coffers full of it, or maybe not full, but let's say half full to continue burning. The other thing that has happened, there's been a number of head fakes, things that look like they were going to turn to a bust between 2011 and now, certainly including 2020 began with what looked was going to be one hell of a bust. Every time a company would have made a layoff during these head fakes, they regretted it shortly thereafter. So we've trained, it's like the village hearing the boy who cried wolf. But suppose in reality, the wolves actually are coming down from the mountains and they're howling and they're getting pretty close to the kid. He's not just messing with the villagers. He's actually saying, I hear the wolves. But after 5 or 6 or 7 times of that, the villagers are like, stop with the wolves already. And then, now that the wolves are really upon us, I think companies are apt to be slower to lay off, slower to close poor performing units, because they've done that so many times in the past. They've been burned every time they did. They went back to employees they'd laid off, 4 or 5 months earlier, begging them to come and take their jobs back and paying, double the money and so on. So you get all these factors. What really is going to cause the crisis is the defaults. So how many companies were zombie even before interest rates went up? I think it was something like 20% of the the Russell 2000, for example. I think about 20% zombies. So now you hike interest rates, all the zombies are even worse zombies, and then a whole bunch of companies that didn't used to be zombies at 0 interest rates are now made zombies by raising the threshold, raising the bar.
So, I remember you answered this question in a sort of similar line of thought, the interview I was listening to. But a thought that occurred to me is, like, for example, if I have a mortgage that I pay the same amount of shekels or dollars every month, and the interest rate keeps going higher and higher, the bank that gave me that mortgage is losing more and more money every month. So even if a company, you mentioned Ford got lucky because it was playing musical chairs, it was sitting right in front of a chair, and GM wasn't. But a lucky company on the other side of that coin is a bank that's very unlucky. So either you have a company going out of business or you have a bank failing. I mean, they happen at the same time.
That's right. And then when did the bank last top up their cash? When did they last do their bond issuance? And so, anyways, the point is you can get some lags. And since bonds are issued with 2 or 3 year maturities, fairly typically, you can have a 2 or 3 year lag. So the last time that the Fed was hell bent to leather on hiking interest rates in a major way was 2005. And it took several years before the crisis they precipitated finally came. And when it came with a vengeance in 2008.
3 years, yeah.
So but all of that said, I think this time around the effects will be much, much more severe than 1929. Simply because the leverage in the system is much greater. And at that time, you still had gold. You had a Fed to make things crooked and dishonest, but you still had gold as a mechanism to really constrain it, which is why they all hate gold and why they want to banish gold as soon as they can. But in 1929, any saver who didn't trust the banking system could withdraw his gold coin and force credit to contract.
Right.
Today, there's no gold in the banking system. You can't really force a credit contraction. you can trade your dollars for gold, but that's just an unrelated third party trading his gold for dollars. It has nothing to do with credit and the banking system. So I think when this one hits, it'll be much worse than 1929 was. But they have a way of masking symptoms. You won't see bank failures, for example, as you did after 1929, because the savers are disenfranchised. There's no way to pull.
Instead, you'll just see the currency tanking. But yeah,
you'll see the currency tank, but perversely, the currency becomes bid up because all the debtors are frantically, desperately doing what they can to get currency units to service their debt. It's very perverse. It's not just a quantity. If you read my writings, it's very much not just a simple quantity equation.
Yeah,
it's all these things that happen along the way.
It's like a Kleiner bottle or a Mobius strip of finance.
Yeah, I like those analogies a lot. Like something that's almost paradoxical. The last time I read about a Klein's bottle was like reading about nuclear fusion containment and junior high or something. But a Mobius strip, like you take this thing and you cut it all the way around, and it's still only one strip. And you're like, how is this possible? Two strips, right?
Yeah,
it's like paradoxical, and of course, it's obeying physics. It's obeying geometry in a strict sense, but it gives you a very counterintuitive, result. But so isn't a Klein bottle, if I remember, a Kleiner? Isn't that
Klein bottle? It's a three-dimensional Mobius strip. It's if you could make a Mobius strip the Mobius strip is 2 dimensions, but a Klein bottle is if you could do it in 4D space, then you would come out 3D flipped on the other side. Whatever that we can't do it in space, but it's like
it has no interior or no exterior or something like that.
Yeah, it's a bottle, and then like a tube goes up into it and then back into the mouth of the bottle.
Right. So it has no. Is it no interior or no exterior volume?
It's either it has one side, just like a Mobius strip has.
So no interior volume, but it looks like it contains, So you get this paradoxical, because the flip side of the dollar is debt, you're increasing the quantity of what we call money, but you're also increasing the quantity of debt. And the servicing of the debt is a black hole.
Yeah. This is exactly. I've been thinking about this. This is a black hole of finance that we're producing, and then what happens when when we go supernova, it becomes a black hole, and then all the fiat is like sucked into it, and it's the end of the financial universe as we know it. But then it's the birth of a much better world after some chaos. But I hope we live through that and we get to the other side of this, because I'm really excited to see what's going on, and I hope we survive it. But that leads me to my last question. It's a good segue. At the end of Theory of Money and Credit, right, in Mises' 1912 work, he got, I think maybe with the appendix or the last chapter or something, he goes on this like fantastic sort of rant about if we want to stop central banks or we want to stop the credit machine, we got to get used to putting gold and silver coins in our pocket and using those things to buy stuff with. Now, that I think will only come when it is absolutely necessary and people have no choice because nothing else works, right? And that's when the stackers, I think, have the greatest transfer of wealth to their pockets, because they have all the coins. And then they can just buy, like you in Berlin in 1923, you could buy a house with $100 bill, which was about 5 ounces of silver at $21 an ounce. And I see the same thing happening for a short period of time in a hyperinflationary collapse. And, that's when there's just no choice. But what do you see in the end game when the dollar finally does collapse? What's the day after? Are people actually using gold and silver coins to buy their food and buy their cars and buy their houses? What the hell happens?
I have a very bleak view of what happens after what I call permanent gold backwardation. And the nearest analogy is 426 AD. 476, excuse me. I have a 20 from
the collapse of the Roman Empire, yeah.
Yeah. And production collapses. Our industrial civilization depends on, and having big cities depends on producing energy and food. And of course, food depends on energy anyway, in industrial quantities, and vast processes that are capital intensive but not labor intensive. And then this is the collapse of the capital base is really what we're talking about. And so they can't produce food and energy anymore, certainly not on a big scale. So if somebody has a little garden, sure, they keep growing in it, but you won't be able to get insecticide or fertilizer anymore and you won't be able to get diesel even if you're a little garden tractor.
Yeah, and you'll have to protect it from all the hungry people around you.
That's right. So it's a Mad Max scenario, except you won't be able to get diesel, you won't be able to get machine parts. So if assuming you manage to stave off all the zombie hordes that are after you to steal your food, eventually you run out of whatever diesel you had in the tank. You can't necessarily machine. Very few people are capable of machining all the parts they need for their tractors and combines and whatever. And then we're sort of plunged back into best case scenario, 18th century agrarian, before any technology that as we think of it as such, occurs.
Yeah, but with much less skill, because none of us know how to do that anymore.
Nobody knows how to do that anymore, which makes it a lot worse than 476 AD, where most people still had ties to the land, and obviously an enormous collapse of the population. You can't, North America would support maybe 30 million people, assuming peace anyway. And population is obviously, 400 million or something. So it's a really bleak scenario. And now the other thing is, if you look at after 476 AD, it's not that anybody stopped valuing gold. Absolutely, it was very precious. In fact, it was too precious to show anybody that you had some of it, because they'd kill you for it. So the gold didn't necessarily circulate after that. The gold went into hiding.
Yeah.
The kind of thing that people didn't even tell their own kids until their deathbed. Bring my eldest son to me, as the old man croaks out his last, and then he tells his oldest son where the gold is hidden. And the son didn't even necessarily know they had any gold, because they weren't spending it or living on it. The kings obviously had gold, and they spent it and used it and whatever, because who's going to attack the king to take their gold other than another king? That's called war, which of course was endemic, in those times.
So we got 2 minutes left. I just wanted to say that I understand what you're saying, but I can't think that way, because I would lose my mind, and I wouldn't, why would I take care of my family if I think because I think the end game's coming after the next round of money printing. I have to have a much more positive view than that, because otherwise I wouldn't make it. But maybe you're right, but I can't really entertain that. But anyway, we have about a minute and a half left. Tell people about monetary metals and what they can accomplish there, how you can help them, and we'll put the links in the description below.
So it's a perfect segue. We're trying to avert that Armageddon rather than stack in preparation for it. And how do we avert that Armageddon? We get gold and silver to begin circulating before everything collapses.
And even though life would never be simple or innocent again, as he savored that spongy yellow log of cream, we had hope.
And create a graceful transition path. How do we do that? By making it profitable to invest in the gold standard. How do we do that? Deposit your gold with us and earn interest, and silver too. Earn interest on it in gold and silver. That is our value proposition. That is our mission, is to pay everybody who wants it interest on their gold. And come visit our website, monetary-metals.com. We've got tons of material on everything from how the product works to the economic theory and everything in between.
All right. So the link's in the description below for that. And Keith, I really appreciate it. And I'm sure we'll talk again. And, stay positive. I think we'll be okay. I have to say that.
I hear you.
Okay.
All right. Well, thanks for having me, and have a good evening.
You too.